Okay. Start this with shop discussion or shop evaluation. Okay. We bought the April 18th 212 and a half, 220, 222 and a half broken wing fly. Which, by the way, I call that the Raven spread. And we bought that for $1.70. Okay. At the time, the stock, I think it was around 203. Let me check our tracker here. 203 and a quarter. Okay. Everybody on board so far? Okay, well, lo and behold, things really unchanged right now. Okay, so stock is now 205 and a quarter. And the spread is still $1.70. Okay, so if we're looking for 70%, then we would want to exit this thing at roughly $2.90. Okay, so we're looking for $1.20. Well, we go through the same analysis. Okay, this broken wing fly, it's 11 delta. Okay, pretty easy math, right? If we need $1.20, we need roughly $10, $11 to the upside here. This is a good one, though, because I want to show you guys something. So just based on the delta move, right, we need 10, 11 bucks, right? $11 would be $1.21. So we need an $11 move or the stock to be roughly 216. It's 205 and a quarter right now. Okay. Everybody see that? Everybody get that math? Okay. However, that is a move based on delta today. Okay, when I say today, we're factoring that delta today and also not using not bringing in one of the other Greeks called gamma. One of the Greeks that we rarely talk about. Okay, delta measures the theoretical value change in an option with a $1 move in the stock. Gamma measures the change of the delta with a $1 move in the stock. As a stock starts moving towards our options, towards our options being at the money, gamma picks up. Gamma accelerates, meaning the delta then also accelerates. Exactly, William. Okay, now, right now, in this spread, it's really gamma neutral. We have one long call at 212.5, two shorts at 220, one long at 222.5. And as you can see, the gamma is really zero. So the delta doesn't change. However, if we start pushing the date ahead a little bit closer to expiration, look what happens to the delta. The delta does start to change now. Right? The delta does start to increase. Everybody see that? So when we do these calculations on the value of an option or the value of a spread based on delta, keep in mind, folks, that it is really for, you know, a short period of time. And that if we extend that time frame out and get further and further along the way and closer to expiration, those deltas are going to change. Okay, additionally, let's go back to the screen here, or the whiteboard. Okay, so we just said we needed the stock to be 216 for this thing to be worth 290. Okay, what would the value of the spread be at expiration with the stock 216? If it were all the way at expiration, what would be the difference, if any, in the value of that spread? Anyone? What would the value be? Come on, this one's not... Yeah, there you go, Roger. I was going to say, this one's not real difficult. The value would be, Shane, it would be 350. The difference between our long strike, which is the 212.5, and the stock price of 216. Okay, so it would be $3.50. So the relationship between the value at expiration and the value today at the same stock price is about 60 cents. That's how much we would stand to pick up if we let it go all the way to expiration. All right, so Steve, you probably got more than you bargained for here, but that's my explanation in shop. Sure, Peter. At expiration. Okay. At expiration, if the stock is 216, the only option with value is our 212 and a half. 216 minus 212 and a half is 350. All the other options are worthless. So that's how we come up with the 350 at expiration if the stock were 216. Okay, any other questions here, guys? Steve, thanks for bringing that up. Well, David, so like every single other signal, what would be even better than 218? Exactly. And why is 220 better, and why is 220 actually the best spot for us at expiration? No. Anybody, why is... See you, Roger. Have a good one. Yeah, it's the short strike. Right? We always say we want our spreads to go to our short strike. Well, this is a perfect example of that. We max it out. We max any of our spreads out with the stock at the short strikes. Theodore, are you asking in general or for a specific signal about the calendar spread and expiration?